Okay, it's already 1700, so I believe we can start.
Yeah, go ahead.
Yeah, ladies and gentlemen, thank you very much for coming. Thank you very much for putting that much trust in me to my humble understanding of credit management. So I'm really pleased to welcome all of you, and I got very nice company, you know, in face of Declan Flood. Declan, thank you very much. Special thanks goes to you. My name is Andriy Sichka. I am, for the last quarter century, I'm paid for helping companies to manage their credit, to getting the most out of their receivables portfolio. I did quite a long way in this profession from collecting of outstanding loans in Ukrainian local bank to managing of quite big portfolio of multinational company with about, I don't know, I don't remember, maybe 7,000 or maybe 10,000 customers in 100 countries around the globe. So actually my portfolio was never sleeping at all. And recently, in my consulting capacity, I had a great chance to have a look and verify and think deeply about how companies take their credit decisions. So I got something to share with you. Again, thank you very much for putting that much trust to my humble experience and my views. The key issue to me, the key issue with the credit management, why I am so concentrated about decisions. If we have a look at history and take one of the most quoted case of bankruptcy like Enron, which happened more or less 20 years ago, and take into account several, just let me quote the Professor Altman. That was 20 years ago, and credit management evolved a lot in this respect, I believe so. But 20 years ago, there were tools to manage credit, and there was already a formula, Z-score, Altman Z-score, and other formulas to predict bankruptcy. And there were signs saying us that bankruptcy of Enron is coming, but technically speaking, no creditor has withdrawn their credit facility. So I just want to mention that we, modern industry, modern economy provided us with a quite substantial amount of tools and instruments to manage credit, but if we don't use them properly, if we don't use them to take decisions, we won't have better results. So like whatever tool we take, from pistol to sword to knife, it could be good tool or bad tool, but what mainly defines the results we get is the way we use it and how we decide to use this or that tool. So our today masterclass will be dedicated to trade credit decision making. So how the companies, what companies need to pay attention to, and maybe approaches they can take in order to get better results by the way they are taking their credit decisions. So let us get started from quite simple thing. I just would like to share with you just a second. I will find my presentation. Yeah. So let me start from the since Declan is already here. Once I was impressed by his presentation. and he said that we are concentrated too much on what we don't like. Therefore, we got results we don't want. So today, I would like us to concentrate on what we don't like first. I mean, we start with what we don't like, and then we try to see what we really like, what we really want, what we need to achieve. So I just chosen 3 main stereotypes which exist in the world of credit management within companies about credit decisions. So just to take them as examples. First one is risk assessment is already a decision. I believe it is the most common. I do know, I got a friend who used to work with me as a salesman. We were working together, we were exchanging ideas and thoughts, and I believe he's able to manage credit much more better than me in certain situations. But once he said a phrase which really surprised me. If you look at that customer, he told me, you would never give him a credit. I said, why? Just that the credit worthiness itself, credit worthiness of the customer is only one part of the total credit equation. And the customer might have low credit worthiness, whatever way we define it, but this is only part of credit decision, because there is second part, there is an opportunity, there is risk and opportunity. And this approach, which commonly used, by the way, in banks or in companies who got luxury of having hyper demand on their products, this approach is okay for them, because if one customer would leave, they got 3 or 4 others who will come and buy. But this luxury is available only for, I would say, 10 to 25% of customers. Others have to compete. And if majority of companies, have to compete, they really have to take risk. And for them, such a policy would be a huge mistake. Obviously, we can use security and other instruments, which we will discuss further, but simply risk assessment is a ready-made decision, is a very common stereotype, which might be a dramatic mistake for a business. Another way to manage credit, even more common, says no money, no honey. It's mainly not to credit terms, but in certain terms, this is like applying cash in advance terms to all the customers. But mainly this principle belongs to the stage of credit control. If customer don't pay, we don't ship. Or if customer exceeds the credit limit, we don't ship. Okay, there could be situations where we need to apply such a rule. There could be situations where, like, during the crisis time, during many different situations, where this rule is really a principle. But if we apply this simple rule everywhere to every customer in every situation, I don't believe the company will get success. Again, we discussed that deeper, but simply say no money, no honey approach in everywhere, in every business, in every company, could be really a mistake. Again, if some entrepreneurs or managers of the company are happy to accept volume drop, please try it on, if somebody wants to gamble with their money, I don't mind. But I will give an example in the end, which quite simply illustrates what I'm talking about the stereotypes. And then the last one, collect and get. I don't know how many times I was trying to criticize this over-reliance on collection. If you look at social media, you will read how many advices about credit management are saying you need to collect, you need to effectively collect. But again, I am sorry, if we concentrate our credit management efforts only on collection, so if we just, let's make it quite simple. If we just, pump our sales, we push our customers to purchase more and more and more, and we sell, we ship as much as we can, and then we start collecting cash, it would be very, very far from being successful. I don't believe we will reach success because customers, if we just sell without paying attention to customers' credit worthiness, without controlling, without understanding how much volume it is possible to sell, we have to expect with such an approach, with such an over-reliance on cash collection, we might expect overdue, and bad debts come into our, come into our balance sheet, come into our finance, and overdue collection becomes endless job, which is very good for collectors, which is very good for credit managers, but I'm not sure this would be very good for the business. I promise you a practical example, and being politically correct, I try not to mention names of companies and even names of the markets, to maintain really secret which shared with me. But on one of the markets in Europe, there were two FMCG companies, and both of them, in more or less the same time, applied quite simple policy. They said to their customers, dear customers, you would have either cash in advance or bank guarantee. So either cash in advance or credit with bank guarantee, nothing else. You choose. One company lost their volume, lost their sales, and had to review that policy in 3 months. Obviously, had to accept quite big loss in terms of profitability. Other company simply had discipline and customers started to pay. Absolutely the same policy, absolutely the same approach, more or less the same FMCG companies. Obviously, there was a difference between them too. But you can, if mentioned, by the way, in chat, if you, yes, it's, ladies and gentlemen, please, don't forget to comment, don't forget to ask questions. There is a good question from Mark. Endless collection good for credit managers? Yeah, because credit managers has job. Because credit managers has something to do, and they continue to they continue to get their salary. Yeah, obviously that's exaggeration. I mean, I believe this would be, yes, for collection. I just wanted to say, but you took that from my mouth. Exactly. Yes, exactly. This could be good for collectors. They could be good for lawyers, for everybody. But I'm not sure this would be good for the business. Endless collection. Once I've wrote that post just simply asking, should we collect or should we prevent overdue, and whether credit management exists to collect or it exists to prevent overdue, just making customers. Okay, yeah, completely agree. Thank you very much for correcting me. Okay, but we go further. So if we look at business with the, let's assume we look at business with business owner eyes. We need to see what are the expectations of a business from credit management. Again, what are the tangible results to be delivered by credit management? I took several attempts to think deeply what is the main expectation, and once I found a simple idea. what is the main reason for accounts receivable to exist? As I already mentioned, it does not exist to provide credit managers with job. And I can continue, but we already discussed that with with Mark's comments. We already have that. But main thing, no business wants to lose sales, and credit management exists to facilitate sales. Absolutely, if you try to say that it must be profitable sales, I would agree. If you say sales which will be paid in the end, completely clear, but there are 4 others objectives. First of all, and main one is, again, accounts receivable exists to facilitate trade. Obviously, every business, if we take long-term objective, or if we take what is the real expectation, at the same time, we need to reduce overdue, really down to 0. There could be occasional, but expectation of business, if, for instance, we would be business owners or top managers, what we expect from credit team, collect all the outstanding and prevent their recurrence. So long-term, real expectation will be 0. The same story would be for the bad debts. No one wants to lose money. And in the end, this everything is achievable. All these 3 is achievable in quite simple way. But the problem is this could be too expensive. Therefore, the fourth and balancing all the 3, the fourth objective, which is balancing all these 3, is actually optimal expenses. And what is the real challenge of the credit management is not like achieving one of them or couple of them. You can see it's very easy to achieve self-supported cost of overdue and bad debts, and vice versa. We can easily achieve low overdue, low bad debts at cost of sales. Once I had a nice discussion with a business owner, and he told me, I can make my receivables, ideal tomorrow, right tomorrow. The only one problem I have, how much sales it will cost me. So we need to achieve all these 4 at the same time. That's what makes really credit management challenging. And this guy in the center you see on the slide is really 4-dimensional, rope walker who's supposed to go and stay alive. So that's what makes credit management both challenging and extremely interesting. So how interesting it could be, I will share with you for that. I don't believe you need my video, so I will try to stop it and continue with the presentation. Okay, how we can achieve all of that? This is achievable through one very simple strategy. You see it is already defined. So we need to create conditions where customers purchase companies' products, pay for them, and order again. So this cash cycle is supposed to turn, and to turn without interruption of credit management. So we have to create conditions where it like very one of the very first slogan of Apple, where it just works. That's exactly what business needs. To be much more drastic, I used to say that business does not need credit managers, cash collectors, and credit analysts, and neither of them. What really business needs customers who purchase, pay, and order again. This is it. If this cycle turns, we just got very supportive function. And to me, the strategy of credit management is the credit management, or whoever exercises this function, supposed to strive to achieve that simple result. It's quite simple cycle which turns and generates cash for the company. That's where this cash is king is coming from. It sounds quite simple, and if you say it sounds simple, it sounds easy, but show us how we can achieve this. Okay, let me try to show how it is possible to achieve. I think I got again an issue with my presentation. No. Obviously, there are 3 steps where we take decisions. And management, since we talk about credit management, is coming out of decisions. We take 3 types or 3 groups of decision. First one is which credit terms we offer or which credit terms we have to offer to achieve company's objectives. Then, second decision, what we have to do if current terms become irrelevant, they become obsolete, or they don't serve the cycle, the strategy we mentioned before. And on the last stage where customer don't pay, we need to define the strategy, how we can collect or how we can recover a debt. If we look at the results again, to my own observations, if we take care of terms, we will receive at least 50% or more results generated by credit management. So credit management is mainly about credit terms. About quarter of results will be generated by control, and then the rest is collection. Again, if we talk about all the 4 expectations of a business. Let me go further. So how we can find these unclear, mythic, or ununderstood optimal terms? There are many ways to do that, but the way I tried myself and the way I got proven by my own experience is simply coming from comparison of creditworthiness and credit demand. I will explain in details what both of them means. Creditworthiness, and here we need to be clear what does that mean. Both supposed to be explained in money. So we would be talking about creditworthiness reflected in money, but they would be talking about credit demand. So how much credit we need to give to our customer or to our portfolio. Sometimes it's more or less the same. And how much we can trust to our customer. And then we compare them, and this helps us to define the optimal credit term, the optimal credit limit, and collateral requirement, which constitute altogether the credit terms. So how can we do that? If we compare creditworthiness and credit demand, there are actually four options we might have. But if credit demand, meaning that the credit requested by a customer is below the creditworthiness, this will be quite nice situation. I had couple of times in my practice this. Here the decision is quite obvious. We simply put a credit limit on the level of credit demand and simply go ahead. And we suppose not to have issues if we don't have problem on other stages. But majority of cases represent a situation we have here on the slide, where the creditworthiness is significantly lower than the credit demand. And based on theory of risk management, we got 3 main choices. We got a situation where we may refuse taking risk, so we can draw a limit on the level of creditworthiness. So if for instance it is 0, there would be 0 credit, so it will be cash in advance. We may accept credit risk, this is what you see in the middle, where we simply we accept credit risk and grant a credit limit on the level of credit demand, and we can transfer the risk to a third party using the collateral. And this will technically grow customers' credit worthiness. So we will take lower risk, but very likely this will be at cost for us or for our customer, again, depending on the situation. So what is the, this stays exactly in the middle of the methodology. Why? Because this methodology helps us to see what risk we have to take. And this becomes very clear to everybody involved, to the sales team, to the finance team, to general management, that in order to achieve that level of sales, we have to take specific risk. And since this risk or risk exposure, if you want, is reflected in money, it becomes quite clear to everybody. Unlike with credit worthiness reflected as default probability, without criticizing it, if we got default probability in percent or in any other probability numbers, it become invisible. But if we have credit exposure reflected in money, so we put under the risk this specific amount of money, and then we compare it with the benefit of a transaction, it becomes quite clear that we have to risk $1 million trying to get 10,000 profit. And the decisions taken by either credit manager or sales manager or top manager becomes completely different, because credit risk becomes not like invisible, unlikely event of something. It becomes quite visible and quite, I would say, tangible. So you can see it, and then you take an informed, clear decision. Because very often we can see in decision-making practice, explanation of risk, which you will consider as a fun or drastic or whatever, or just stupid. But I've read that with my own eyes. Explanation from a quite developed business manager who says there is no credit risk because customer paid 2 last invoices on time. And then management takes decision without without understanding what credit risk is and what credit risk is taken. With such a simple approach, again, it is not ideal. I don't try to say it is ideal, but it's just an approach to make credit risk visible, and credit risk the company takes quite visible, and gives an ability to compare credit risk and benefits of transactions, whatever they are. Sometimes benefits of transactions are not financial or even not material, but the question whether or not you are ready to risk this amount of money for that, makes a decision, I would say, very, very sober. Obviously, as I said, it makes quite clear credit risk to everyone. So you don't need to be a mathematician or whoever it is to understand credit risk. So let us see how can we find components. First of all, credit worthiness. In this methodology, it's a little bit different from others, but credit worthiness here is an amount of money which could be trusted to a counterpart without collateral or without present payment. Just how much money we can trust this customer. And it is a product of five main risks. First of all, this is risk of fraud. Second, is a risk of compliance. Obviously, compliance risk may materialize in the losses much more bigger than the outstanding balance of a customer. Then country risk, then industry risk, and only one of them, which is most common, is solvency risk, on which we got a lot of definitions and a lot of explanations, a lot of methodologies on the internet and in literature from academics. Solvency risk, which we normally assess based on customer financial statements, is only one of the 5 scenarios. All other risks are also to be assessed and taken into account. For instance, if we take a simple approach as fraud, we're supposed to be very clear, it's black and white. We either deal with fraudster or not. So unless we are completely sure that our counterpart is not a fraudster, we're supposed to avoid this risk. That's pretty clear. In terms of compliance, is already a little bit more tricky, but again, we're supposed to understand whether or not it is clear, it is possible, it is ethical, and from terms of reputational risk, there is not that much exposure to that risk. And country risk and industry risk obviously supposed to be taken into account. I will show one of examples how this could be done. So when we define how much money we can trust to this customer, we might be clear about how much money we're ready to, what is the creditworthiness of a customer, or creditworthiness reflected in money. I must mention that there is no precise numbers. There are no precise numbers in terms of creditworthiness. So all the calculations is actually an estimate. If we look deeper into details of all the credit risk assessment, all the predictive models and everything, it's not more than an estimate of how much creditworthy our customer will be in the future, because usually financials are about past. So we take an extrapolation for the future and make an estimate how much creditworthy our customer will be. So it's never a precise number, it's always a distribution. Every financial will tell you that a company's financial position is changing every day, every hour, and even every minute, depending on what business it is in. So we need to be clear about what this number means. Then we're supposed to talk about the credit term, and there are lots of factors affecting the credit term. It's an interest, it's a profit, it's a competition, credit risk, law, size, financial cycle, properties of product, and market share, or negotiation power of a company. All these factors are to be taken into account when we define a credit term. Continuing with the stereotypes, I was once very surprised to hear from quite developed person in business with a quite high title, who said, when he was asked what approach you take to define credit terms, he said, we simply follow the request from a customer. Well, this could be an approach in that specific situation for that specific business this person worked in. But if we talk about quite wider methodology, we need to take at least several factors to define what would be the optimal credit term. And then on their basis, we can define the range of optimal credit terms or possible credit terms, and then negotiate with customer and fix it. Again, I will show the quite simple methodology, and my previous masterclass was dedicated to the definition of optimal credit term. So I will mention a bit in practical example today how this could work, and for that, in the under the video, under the final video, there would be a link to that masterclass, so you can see in details how the optimal credit term could be defined. Knowing credit term, we need to define demand. And demand is, again, if we, either in this methodology or in any other, we may see that this, what normally good credit department calculates, this is projection of receivables. So we need to know how much receivables we need to maintain in order to achieve objective of our transaction, either volume or profit or whatever it is. You know, it's always sales and receivables following them. There are several ways to calculate. Here you can see one of the most simple example of that, which is continuous balance. We just got delivery, payment, and final balance, and you know, based on the credit term, which is here, we can define, you know, how much payment, how actually the shipment becomes a payment in certain moment of time, and then we simply calculate and find maximum, which will be 270, which is actually the credit demand for this customer, for this transaction. There is a serious restriction to that, because this projection, and this, again, this would be an estimate of credit demand, is always as good as credit forecast we have in our possession. So each time we estimate credit demand, we're supposed to know that this is only an estimate, but as long as we will look forward, as we maintain forward thinking, we are already doing good job, and we are already prepared for the issues we might have in the future. So we have time, and we are much more prepared than if we try simply to react. So we've calculated, or we found a way to define all the necessary components. So the only thing we need to do now is to combine all of them. First of all, let's say for the first attempt, in a very simplistic picture. So how it could look like? You see, our credit demand is a distribution. So these are these are the levels of accounts receivable, or the balance of a customer for the future. Then we see the credit worthiness of our customer, and we see what would be the credit demand, and this is the amount of risk we have to take if we would like to fully utilize the sales opportunity. If we put here, for instance, this is existing customer, if we put here the existing credit limit, and we are somewhere here in this point, we might clearly see that at this, let's say these are months, starting from the second month, we already have a situation where our existing credit limit, or our current credit limit, would be not enough, and we will have to do something. Again, the key idea is not to avoid risk and is not to accept risk. And the key idea is not to be an automated decision. Credit decisions are not simple. That's the thing I wanted to say in the very beginning. Credit decisions are not simple, and but we have to take them. And then, you know, knowing demand, knowing credit worthiness, we have to draw the line of a credit limit, because credit limit is not something we are able to calculate. Credit limit is not calculatable. Credit limit is only decidable, because demand says us how much credit is needed for the transaction. Credit worthiness says us how much credit is safe for this counterpart. And then credit limit is the amount we will decide to give to this transaction, to this portfolio, or to this customer, assuming both risks. risk of loss of a customer, which is quite material, and risk of loss of risk of a bad debts write-off or risk of financial loss. Because if we come back to this stereotype which I mentioned, where credit risk assessment is already a decision, because their risk of customer loss is really ignored, because there are other customers who are ready to come and ready to take. But if we have to compete for the customer, if we have to compete for the market, this means that loss of a customer will be loss for our business. And technically speaking, in vast majority of trade credit cases, we are about to deal with two risks: risk of financial loss and risk of loss of a customer. Just as obvious. Here we can put, let me take green pencil. We may also here draw a collateral if it works, if it is available on the market, or customer is happy to provide, and so on and so on. So we can put here a security requirements and actually remediate the situation. But again, if it is available or not. And this is where we make a credit structure and define customer limit, customer credit term, and collateral requirement. How, let me first ask before we go to practical example, if you have any question, maybe that's a bit unclear. Absolutely. Absolutely, Mark, I completely agree with you. That's the way. We may call it risk appetite, or we may call it risk exposure. Just a question. I just want to generalize a bit that in 21st century, for the majority of the customers, for majority of companies, it's not a question whether or not to take credit risk. It's always a question. How much risk we have to take in order to achieve our goals. In terms of collateral, and coming back to your comment, Mark, the problem with collateral, with the bank guarantees, with everything, quite big problem, is that credit-worthy customer are very easy able to provide collateral, bank guarantees, or even insurance on them would be very easy. But very often we are dealing with a situation where we have to deal with a customer whose credit worthiness is low, and we have to decide. And for them, for the customers with low credit worthiness, it's not that easy to provide either bank guarantee, or insurers are not very happy with them. And I'm very far from the idea that 100% of credit security is always, like absolute good for the business. There are lots of situations where it may create an issue. We may discuss that on the Q&A session, if you would be interested. So in terms of practice, I didn't take that difficult example, but let me show how all this, which sounds very theoretical, looks in practice. So there is a sample company. It is located in Czech Republic, and these data taken and verified from unqualified source. Countries and import-export are shown in Russian That's my technical mistake. So this company imports from Russia, Ukraine, and Kazakhstan, and exports to Italy, France, and Germany. So customer is not under bankruptcy proceeding. There are no lawsuits. Company registration status is active. So everything's okay with the company in terms of fraud. Compliance check is done. The company is positive as well. Because this is export, we need to have a look at the country risk. For that, we've taken ratings of big three. All of them are investments, so economic situation in customer's country does not affect their creditworthiness. I would say situation is not too bad. Then we try to define creditworthiness in terms of money using their fresh financial statements. Assume that let's assume that we are in 2019 in the beginning or in the middle. That's what was the situation. So the company is growing. The company works. The company works well. Little, their sales are growing. Their equity stay on quite acceptable level. And since we take creditworthiness as a percent of equity, we keep ourselves on the safe side. So this specific model defines creditworthiness of a counterpart as 188,000, whatever currency it is. For our understanding, for the purposes of our masterclass, it's quite okay. I mean, specific currency doesn't matter. So we defined creditworthiness. Then we defined the optimal credit term. You can see here factors on which we were able to digitalize. First of all, it's 60 days restricted by law. Then it's a cycle, it's operating cycle of this customer, of this transaction, which is about 52 days. Profitability of our product based on the interest on financing rate gives us an opportunity to give a credit term longer than 60 days. Then competitors are given from 30 to 50 days. This is which constitute our reach, and product shelf life is quite long, so it is more than 60 days. And optimal, so the optimal range of the credit term will be between 30 and 50 days. And from that, we take sales focused, which is 10,000. We don't have better numbers provided by sales. So at that moment, this was, let's assume it, 10,000 units per month at price of 20. So the sales with this customer would be 200,000 per month. And their creditworthiness, which we reflect here, is 188,000. And then we simply focused and estimate the demand, the credit demand of a transaction for 30 days payment term and for the 50 days payment term. I won't bother you too much about the methodology. It is the demand is calculated. I just say that this is, we've calculated payments and we put certain security margin here for the potential overlapped between shipments and payments, which usually happen when very often it happens when we have to ship to a customer. We have to ship to a customer before customer has a due date and has to pay, and this very often it is controversial. So just overestimated a bit credit demand and underestimated on, applied a bit conservative approach to the definition of creditworthiness. So we got two options, and actually two range of options between 30 days and 50 days. And we take all of that for the negotiations with the customer, and then we discuss. If customer insists on that, let's say on 50 days term, we understand how much risk we have to take, and we can discuss with them all the options of collateral. Obviously, if the collateral is credit insurance, we don't need to involve customer, but we can put it somewhere here in our calculations and simply see what limit is given by credit insurance. By the way, today we had on LinkedIn, we had quite big discussion on about the credit insurance. I'm happy with this tool, but the problem is it is not always not widely available. There are big number of markets where it is unavailable, and we have to involve our customer into the collateral discussion, or we have to involve that collateral to the into the negotiation process. But again, we have to do it, and collateral would be a good solution if it is available. And then if not, we have to think whether or not we're ready to accept such a level of risk with this customer, and we have to be crystal clear about how much risk we take and why we take this level of risk. That's more or less about structuring. Again, the final solution, that's not decision, final solution, it will be individual in every single situation. I used to say that every pair of customer and supplier is actually individual, and we have to be ready to support sales, but with the clear understanding of risk, and to demonstrate as much flexibility as it would be enough to maintain healthy business relation and really profitable sales. Because as we can see, if we take 50 days example and we got exposure of 212 days, although it is conditional, if customer goes bust and our profit margin is not more than 10%, this won't make our transaction and our relations with this specific customer profitable. There is an approach and there is an idea saying that bad debts, zero bad debts is not really a target, because we might have bad debts, but bad debts is actually a, say, sort of payment or sort of expense of doing business. In general, I agree with this approach. I even agree with this approach on the portfolio level, but to the extent it is known to me, it's quite difficult to have high profit and bad debt with the customer, at least within the same year. Obviously, if we take a long story with the customer, for instance, if we make business with a customer for several years, or I had a luxury of to see the customer who worked with my company for 75 years. Obviously, if we take it this way, yes, we could have high profit and some bad debts in the end, but simply having within the same year higher profits and bad debts with the same customer, it's very unlikely. So to me, maybe that's too optimistic or too idealistic, but to me, we have to maintain the level of bad debts on as low as possible level. Obviously, companies supposed to have could have occasional bad debts, but if we look at our company's annual report, and we see that our overdue is growing and that our bad debts are growing, I do believe there is something wrong going in our company with credit management. We have to be very honest with it, and I'm pretty sure for the major part This belongs to the way we take decisions. Either we as credit management take them, either CEO or CFO takes them, or general manager takes them. But in general, within the company, if we look, as we started in the beginning, if we look at our company with the eyes of owner or shareholder, there is something wrong with trade credit decision making in our company. That's what we have to admit. As I said, there are three groups of decisions. The second group, or credit terms review, could be made based on the same methodology which I explained above. Every time we got a situation where our credit terms, terms of credit limit, credit term, and security requirement become irrelevant due to whatever reason it is, credit limit is not enough to maintain sales, or customer don't pay due to A, B, C, D, X, Y, Z reasons, meaning that our terms become unsilent, there is a need in our interruption into that. We got actually three choices. We can insist on our terms, let's say in situation where there is a customer or an order from customer which does not fit credit limit. We have to react on that, and we're supposed to provide an explanation and arguments why we take this or that choice. We can insist, or we can make an exception if we see that higher demand for sale, higher demand for credit is just a temporary, and we can change our terms, so we can review that and align them with customer. The same story could be with the payment term. For instance, in a COVID time, there might be a demand for the longer payment terms to support our customer and maintain supply chain and maintain relations with customer, because crisis will sooner or later will gone, but customer might not be happy to continue relations with us if we refuse to support them. I've seen a couple of situations in my life. And again, this decision is supposed not to be romantic, because the customer might be simply unable to do business or to continue business. And we're supposed to invest our company's money in the future business, not simply in extending the date that our customer would become bankrupt. There is no simple decision here. There is no simple solution here. And we just need to be very, very sober about what we do. And we're supposed to be very, very clear about why we take this or that decision. Again, methodology is just another cycle of what we discussed above. We take new credit worthiness, we take new credit demand, and we see what are the options in terms of collateral, and we just change one setup for another one, maintaining or trying to reach the same silence of credit terms. Once I was asked by one of my teams, what are the ideal, what is the sign of optimal credit terms? I simply said they're supposed to be silent. It's supposed to just work without our interruption. Customer ship, pays, orders again, and it works. And if we do our job well as a credit managers, we see the possible issues with this customer. We foresee them before they happen, either credit limit excess or late payment or whatever it is, and we're supposed to take care. We were supposed to take care of necessary change or exception or whatever it might take from us to find a solution and to remediate the situation, and just maintain that silence. Obviously, there would be a situation if we take care of credit terms, if we control the adherence to these credit terms in practice through the credit control, we're supposed to have very low amount of overdue or whatever cases to collect. But we supposed to be, and every credit manager is to be, to my humble opinion, every credit manager is supposed to be able to come to customer and collect cash, to demand the payment which belongs, which is due to our company. But here there is a tricky point. To generalize, there are two types of obligors with overdue outstanding. One of them, one which I believe would be bigger side, is our customers, and then there are debtors. Every company and in every situation define themselves what is the difference between the customer and the debtor. But these are two different strategies, because the customer, to give a simple explanation, the customer is a counterpart with whom we got a perspective of cooperation. We still got perspective of sales and common business. And the debtor is just a company we need to collect money from and say goodbye. In both cases, we have to maintain relations. In both cases, we have to maintain the dialogue. But this would be absolutely different, different recovery strategy. And for the customer, this would be obviously much more flexible, although firm, because we need to see money from our sales, and we need to maintain sales. In case of debtor, we're supposed to maintain contact, supposed to maintain dialogue, but we are much more free, and we got much more wider range of tools which we can use for collection. In this case, we can give it, we can assign this specific amount to collectors, or go to court, to arbitrage, or to mediate, or whatever it is. But there is no perspective further. We just need to collect our cash as effective as possible. So the key strategic point on the recovery strategy is we need to distinguish as early as possible whether or not our counterpart at this exact moment is customer or the debtor. Coming back, just to mention in the end, if the customer or whatever, our counterpart, is solvent and they got cash, I believe you all are experienced people, and you know that if the company has money and the reason for the debt, there is no dispute for the product, for the delivery, for whatever it is, the recovery is just a question of technique. You can do it in one day, you can do it in one telephone call, or maybe in couple letters. If the company does not have money, the collection becomes very, very tricky. Therefore, it is quite necessary to continue to monitor the creditworthiness of our counterparts in order to avoid difficult situation, even if we have to collect. I actually shared everything I planned for today. Surprisingly, I did that in nearly an hour. And I am happy to answer your questions. I will put back the camera, stop sharing the screen, and I am completely yours. And put on chat. If you are if it is difficult for you to, if it is difficult to define your question, you can also always write it to me, or on social media here. But our open air today is just for your live questions. So I am here. I am at your services. Please ask your questions. And if you want to ask your question in voice, feel free. Yes. Thank you very much for your comment, Mark. One of the things I wanted to mention, in the end of my presentation, but I just decided to leave it for the later stage. And first of all, let me thank you for supporting me. This quite new methodology. It always seemed as controversial. The thing is, the thing which is not normal for other people is called magic. It's called magic because especially when you demonstrate what is the difference in results. So it is called magic until it becomes science, I would say, like this. So credit management has certain level of luck, has certain level of magic, certain level of intuition, but a lot is dependent on the approach credit manager takes, on the qualification credit manager has, and the attitude the credit manager demonstrates. So the combination of all of that is actually bring results. Some of them are not obvious, some of them are not guaranteed, but in general, if we compare with other company, or with company who receives who gets lower results or not that good results, you will see that it's quite thin. But again, my strong opinion is that good credit management is supposed to be seen in results. And then magic, you mentioned, Mark, absolutely correctly mentioned. The magic is sits in the end. So how it is done is really the magic stick in the hands of credit manager. I might say, where, I mean, if the audience allows me to share one of the ideas where this magic is. I was attending the course of a banking expert, Joe Pimbley from Risk Management Association, and he said, in banking, there is only one correlation between quality of lending or results the bank has and something. So the quality of lending and results the bank has from lending is only correlates with the understanding of customers' business by a credit manager. So the better we understand customers' business, the better results we have. It's not only is actually where the magic is. It's I mean, I would say this is this magic to the substantial part is actually knowledge, deep knowledge of the portfolio, deep knowledge of the market, deep knowledge of sales, deep knowledge of customer situation, and so on and so on. Yeah, I mean, I've read your Mark, thank you. I've read your comments just after I said what I said. Deepak said, asks a question, risk of financial loss versus the risk of customer loss. Could you provide some suggestions on how to balance, mitigate this in real business situation? that's what was this my today's presentation is about. Let me take theoretical example. Just quite simple example. I had a customer, and actually I lost. I had to use the bank guarantee in my life only 2 times. First time I've lost money. No, not that big, but it was only, and it was the only case I've lost. I had a bad debt. But another one was the customer who was about to commit what is called long-term fraud. And I was in quite deep contact and, quite good contact with the salesperson who was actually an account manager for this customer. And he told me that, there is something wrong with this customer. They are about to commit, or we suspect that they might commit something wrong. Obviously, company needs volume. Obviously, this is FMCG business, and if we lose customer, we might have a loss of potential opportunity and potential potential profits. But because of our collaboration with the sales manager, we assessed what the territory is covered by this distributor, which distributor is able to take it quite quickly if something wrong if something wrong will happen. And then we've seen that, signs are continued to come. So what we decided to do is that we had a discussion with other customer who can take part of that territory. And then we talk with, a couple of other customers who's supposed to take over the volume of this customer. And for this suspicious customer, we simply push the credit limit down to the level of the bank guarantee. So we keep ourselves on the safe side. We reduce the level of credit limit. I just want to mention that very clear. Only when we had a clear agreement with other customers, so they are ready to take over these volumes. Obviously, we've seen that these customers are really credit worthy because higher volume presumes higher level of credit demand, so higher limits, so higher credit risk. No, not risk, but risk exposure. So we align this everything, and we push down that bank guarantee down to the push level of credit limit down to the bank guarantee. Then I was on the business trip, and I was speaking on my mobile phone quite emotionally, and then people who were surrounding me. There was like a joke that what happened to this guy? Here is Ukrainian credit controller. What happened to him? He had a customer who went bust. And why he is so happy? Because he has bank guarantee for the whole amount. So quite a joke about myself. That was funny situation from the practice. So again, to give you, Deepak, answering your question, how to deal with this couple of, this pair of risk of, these interconnected risk. You just need to foresee what could happen. For instance, in this methodology of holistic credit management, we use a tool which is called holistic cost of servicing receivables. And if we lose a customer, we're supposed to see how much money we have to spend to attract new customer and how much profit we would lose if this customer is going to, we will go to our competitors. So how much volume, how much profit we would lose. This altogether will constitute the cost of customer loss. And then we have to compare that with the loss of a bad debt and then take, just decide. Again, these are only financials, because I always say that in case of a bad debts, in case of customer bankruptcy, we financials, we credit managers, we might cry, we might take, a shot or maybe several shots of strong alcohol, but this will be, and then in the end we write a debt and this would be it. But when we talk about salespeople, they have to find another customer, they have to attract this new customer, they have to, or we as a company have to attract this new customer, and we have to convince this new customer to purchase from us. And this all will take time, and all this time we will be paying our salaries and so on and so forth. So loss of a customer is not an easy thing for us. And in terms of when we got customer who is going bankruptcy, we actually supposed to remember that we lose both. We lose money and we lose the perspective. And there is no easy decision to that. Let me check. Yes, thank you very much for the good question. I will answer it obviously, but I need to see other comments. Muhammad is commenting, in my opinion, on our main target is to protect company receivables and maximize the collection to support the company cash flow. But if the management insists to maximize the sales and take the risk without guarantee, then the credit controller can't clean their mistakes. I would like to share with you my personal experience. Is that I came to credit management in trade, in FMCG from the bank, and I was protecting company assets, and I had a really a magician CFO. He's very nice personality and was one of the best CFOs I worked for in my life. So I was protecting, I was standing on limits, and I was trying to reduce the exposure, and I believed I am doing a good job. And once in the discussion, he simply asked me, Andrei, can you tell me how much profit do we get from the goods on our warehouse? I didn't answer to him, because the answer was just as obvious, yeah. Because goods on the warehouse don't generate any profit, so we have to take risk in order to sell. But again, we have to be very clear about what risk we take and what are the benefits. And our side of the transaction, our side of job is to show to higher management, if for instance we don't have underwriting capacity or underwriting authority, we're supposed to say, okay, it's not like we only take risk or we don't take risk, but we have to be very clear about what risk is associated with the transaction, with this transaction, and then either we are balanced or weigh this risk against the benefits, or management takes this risk. Quite often credit practitioners are unable to explain what do they understand under the credit risk and what is the exposure. That's why this part of the story is not taken into account when management take decisions. I know all this pain and I know I can even explain why top management, in vast majority of cases, take the side of sales. Long story short, because, if we don't ship goods to a customer, Let's turn it differently. Customer with low credit worthiness still has chance to pay, but if we don't ship goods to them, there would be nothing to pay for, so we don't have cash. Cash is king, absolutely, but king was born from the sales. So the cash, majority of cash flow is coming, the vast majority is coming from the sales. So if we would like to have cash, we have to sell first. That's my understanding. Obviously, there are different situations. If the exposure is quite high, obviously we can use the conservative approach. But again, we need to take into account both sides of the transaction, risk and opportunity. We cannot take good, effective decision if we only see only one side of the transaction, whatever it is, either sales or profits or credit risk. From Sarah, how would be the best to raise the profile of credit control internally within the organization? As I feel credit management as a whole sometimes suffers a stigma within an organization that we are in finance. Hinder sales by assessing risk for sales for new customers. How can we reasonably control expectations internally? If you allow me to answer quite short, you need to become a friend of sales. We cannot rise or increase the profile of credit management if we will be only controlling, assessing risk, and collecting cash. To my understanding, the role of a credit manager is to go hand in hand with the salesman to customer office and find, growth points for the company business. Finding a way to say yes to a profitable sale, to support sales, credit exists to grow sales. That's what I mentioned in the very beginning. Receivables exist to maintain trade, to facilitate trade, and credit management, the primary consumer of credit management is sales. So if we would like to increase our profile, to increase our contribution to the company business, we need to move from that controllership or protector attitude to a winning attitude, to the hunter attitude of finding a way to get more sales, to get more cash. Obviously, applying all the tools we have in our hands. To give you an example, maybe it could be, it's not that practical, not like it is not applicable to practice, but it's quite wide without mentioning specific situation. But I just wanted to mention, do you know why one of the best friends of the good salesman is credit analyst? I just partially already explained that, because if the bad debt happens, we write off, we drink our whiskey or or vodka or whatever it is, we cry a bit on each other's shoulder, but then this is it. We next day comes to us, we come to the office and continue operation. Our sales colleagues supposed to find new customers, supposed to attract new customer, and they got a whole bunch of different headaches we're concerned with the finding new customer under pressure. So the good salesman, and if you ask a salesman what is the best customer, they will answer you easily: constant, because there is already a trust with this customer. So assuming that there might be something wrong with this customer. The best guy to advise salesman about something wrong could happen with this customer, so they can find new customer, they can find replacement in advance, would be credit analyst. So good salesman supposed to have friends among credit analysts. That's one of the possible ways. Another way is to train and to attend sales meetings, knowing what are the challenges of the company, knowing what company is doing to grow the business, what are the growing volumes. So there is a growth of the company, and then in advance provide salespeople with the solutions, with the possible options, how we can support this growth with volumes. And the last option, the last advice, the last advice to tell is sharing with the salespeople the creditworthiness of customers. Once I did a portfolio analysis for the quite small audience within the company. At the same time, this was the general manager for the region and the CFO for the region. And I did a portfolio analysis with them. And I presume that this is good information, but I didn't mention that in this presentation. I simply shown that for certain customers, they got a creditworthiness. So several customers in this portfolio got a little bit higher creditworthiness than we give credit. So creditworthiness is higher the credit, and this general manager, who in most part of his background was a salesman, he said that's very good to know, because we know where our potential of growth, where we have a potential for the growth, potential to support growth, which is very important for the salespeople, for the business people, for the business development. And maybe 3.5, very good. Imagine you are a salesman. If we try to walk a mile in the shoes of a salesman, imagine you find a customer, you spend a lot of time and efforts to convince the customer to on all this negotiation, and then you come to credit department, and that credit manager, there is a credit manager who is sitting and saying, sales is not complete. A sale is not complete until it is actually paid for. Oh, thank you very much. So all this time, all this effort is supposed to be wasted because customers' creditworthiness is not as high as expected. So what we can do, and I believe that's what we should do, is to maintain that level of relationship with our sales colleagues, to discuss. So they come in advance. They come in advance and ask us for the very quick preliminary assessment of counterparts' creditworthiness, so they don't waste time of the customer in very difficult financial situation, or they're supposed to have a hope that we will find a solution, we will find a setup or set of credit terms which will be suitable for this transaction. That's absolutely normal. So there are, I believe if we start think in this direction, I believe we will find the whole bunch of options how we can help work with them, work with other departments, with our stakeholders like treasury, like accounting, like general management, and really increase our contribution, real contribution, not like we are sitting and talking on every meeting, repeating the same final mantra of cash and king or whatever it is. No, just finding a way to help others to succeed, because to my strong opinion, credit management is a function which becomes successful by participating in the success of others. as a matter of slogan, this could be like this. If we would like to have a motto, I may suggest this one. Deepak, come back to your question. What are your thoughts on credit insurance versus credit risk management? What is the preference of most companies and why? I mean, I don't know the preferences of most companies. Please don't worry, we still have time to answer questions. Every tool is good if it is used in the right place. There are companies for whom credit insurance is a great help, because credit insurance helps to happen transactions which won't be possible otherwise. At the same time, we're supposed to, if you remember the presentation where we said there is a poor guy who's supposed to find balance between the four objectives of credit management, and cost is one of them, and cost is one of the most important of them. I will make another masterclass on credit management, and I will explain why we're actually supposed to take care mainly on the cost. All the other components will come themselves. So it's kind of known example. We might be able to cover our portfolio with security tools, but these security tools with collateral or insurances come in with a cost, and very often this cost of insurance is exceeding the bad debts. They might exceed the bad debts. The bad debts we would write off. That's what happened, and that's why I know at least two companies where I got direct evidence. One of them is my personal friend of mine. He said we just gave up credit insurance because it is too costly. We better assess risk and manage this risk ourselves, rather than we will be paying these premiums, because total amount of premiums over the horizon of 5 years was substantially higher than the bad debts they would write off if they don't use if they haven't used credit insurance. So it's always a balance. There is no simple way to say the credit decision is to be like this or like that. It's a quite big. It's too big luxury. It's too big luxury for us to simplify credit management. I don't have good news in this respect for you, ladies and gentlemen. To my personal opinion, credit management has never been simple and will never be. And the harder the times, the more difficult it is. And the worst thing we can do for our companies, for our careers and for our operations is to simplify it. Simplification could be acceptable, in certain situations where we have luxury, in majority of cases where we have hyper demand for our product. But, for that, credit management becomes simple. In majority of cases, we have to compete. Therefore, we have to manage, meaning find solutions for every situation. Good question from Mahamad. Mahamad, thank you. From your opinion, do you think credit control department is operation department or supporting department? And who has to take the responsibility of the bad debts in front of the top management, the sales team or the credit team? Well, thank you very much for this question, and thank you very much, for being this active. I do appreciate that. I will try to give quite wide answer to that, because it comes to the really deep of my heart. to start from the very beginning, my favorite researcher of management, Jim Collins, says that good employees always say they don't have job, they got responsibility. So to give you the first simple idea, who is responsible for bad debts, as soon as we are credit control, as soon as we are credit manager, this is supposed to always be our this will always be our responsibility, at least emotional one. We always take part in that. This is one side. On the other side, there is always bad debt is not becoming bad, or the debt is not becoming bad only because of decision. Decision plays most part of that, because the final result is defined mainly by the decision. But if we look at the bad debt, as I mentioned today, there are 5 risks at least we're supposed to take into account when we take a decision. Then it's a question, what decision is taken, what risk has been taken. Then the question, how we monitor our customer. Did we monitor the creditworthiness of our customer? Too many companies, I really say too many, assess customers' creditworthiness in the beginning of the cooperation and then forget about it. And they rely on the creditworthiness of a customer, which was estimated about 5 years ago. And this is really a problem. Then another question, how did we control that outstanding and what did we do about that? And finally, when this amount became overdue, whether or not we were effective enough, did we pay enough attention to to this outstanding debt, and did we do our best to collect this outstanding? So there will be to answer again, to come back, and to come back to the very beginning, to very deep of your question, and to the very essence of our profession. We will always be responsible for bad debts. We will always be responsible for the bad debts, even though we are not always taking our responsibility. But that's the only way. That's the only way to do our job. That's the only way to do our job like this. Well, a comment from Alex. What are the best steps one can take to mitigate credit risk in the early stages of customer onboarding? We have a credit application management and so on. Our customers like this. Yes, great to know we are colleagues, and there are many tools. There are many tools to monitor exposure, but I think, and I think, Alex, you rightly mentioned that. I think everything starts with an attitude, with the understanding that customer creditworthiness is not forever. We have to maintain it. We have to monitor it, and we have to maintain, since already mentioned that verb, we have to maintain constant reassessment of customer creditworthiness, and at least every year, because every year customers issue their annual reports. We're supposed to reassess and see trends, and we also supposed to do stress tests for our customers. I mean, about stress tests, it's a quite interesting thing, and thanks to I have to say, I have to make a big hug with the COVID and say thank you COVID crisis for this situation, because I had an ability to say, ladies and gentlemen, if you didn't assess customers' creditworthiness before COVID, now there is no reason to start, because now with the COVID, with the situations like COVID crisis, it becomes clear that risk assessment or calculation or whatever formula is, like Z-score and Altman Z-score, is really not enough, because now it's time to start making stress testing. It's not only model. Creditworthiness is not calculatable. Credit analyst is not calculating. Credit analyst is writing. So we have to monitor, we have to assess credit risk, we have to reassess it every time we got updated customer information. We have to pay attention to trends, and we have to do stress tests. Whatever tool we use to foresee potential issues with customer, we're supposed to use, but we have to remember that creditworthiness is not a precise number, it's not something which will which will necessarily happen if we say about the credit risk, because creditworthiness is always a distribution. It is always a distribution, because company's financial position is changing every day. So again, going forward and forward thinking, whatever tools you find appropriate to your business. We do for our customers in credit engineering, we do on outsourcing basis, we do credit analysis, and some of them order. I mean, it always includes trends, but some customers also order and pay for the stress testing of customers. So it could be reflected in different ways. One of them could be like how many months customer will maintain business if their sales will go down, and so on, or whatever sales decline, whatever sales drop this company can afford or can stand for, and so on and so on. This could be the case. This could be the case, and yes, I suggest you do it. Any other questions? I still got a couple of minutes to answer. Or again, otherwise you can find me on social media. We will publish this video of this masterclass on our YouTube channel, and you can continue to comment, to criticize, and to ask questions under it. Okay, I do thank you very much for your active contribution. Thank you very much for your question, and thank you. About software, I do that everything in Excel, Mark, if you ask me. And again, I'd say that you need to make the deepest risk assessment possible. Try to establish credit limit and monitor well their payment performance habits, and so on and so forth. Yes, Mark, I do completely agree with you. Just to in general, I completely agree with you. Again, it depends on the specific company, practice. Yeah, it's okay. Because we got a discussion. One thing I suppose to mention, if you remember the stereotypes, just for the conclusion of today's masterclass. As I mentioned, when I was speaking about stereotypes like no money, no honey, collect and get, or credit assessment is already a decision, it's not like there is something wrong with any of them or with all them together. The problem with this attitude or with this, sample policies is that they are not widely acceptable. And, to me, every company is supposed to find the very specific number of tools which help them to achieve, the best possible result to build an optimal credit function. So even on the same market, two companies, one of them which will be leader, another one will be challenger, could not have equal or the same credit policies. This would be two different credit policies, two different approaches, and two different credit management functions, which supposed to be built with a clear understanding what results is supposed to be achieved, what the situation the company is in, and what tools are available for this company. So please do not simplify credit management. If you forget everything which was said today, please do not simplify, justify, find the optimal solutions for every situation. If you need help, pose your question, and this will be our pleasure to help you to find that solution. Have a nice evening. Again, thank you very much for your patient attention, and see you on the next our event, which will be either credit charts or masterclass, depending on your choice. Please have growing sales, have low bad debts, have low overdue, or if I can say that in French, bon crédit. Good evening.